This is a bank statement. Your bank statement, probably, or something close enough to it. Shows your balance, your deposits, your withdrawals. Seems straightforward. The number at the bottom tells you what you own. Except it doesn't. That number is a claim, a promise, an IOU from an institution that may or may not have the ability to honor it. 14 regional banks just discovered they couldn't honor theirs. Between January 14th and January 19th, 2026, the Federal Deposit Insurance Corporation seized 14 regional banking institutions across 11 states. Combined assets, $347 billion. Combined deposits, $291 billion. Combined insured losses to the Deposit Insurance Fund, $38 billion. That's the largest five-day banking collapse in American history. Larger than the savings and loan crisis. Larger than 2008. Larger than the 3 bank failures in March 2023 that everyone thought was the peak. And here's what should keep you awake tonight. JPMorgan Chase knew this was coming 6 months ago. They didn't warn anyone. They positioned for it. And when the failures began, they were first in line to buy the wreckage. This is not a banking crisis. This is a controlled transfer of assets from regional institutions to the 4 largest banks in America. And the audit that triggered it was designed to produce exactly this outcome. Here's what they're not telling you. On July 23, 2025, the Federal Reserve's Division of Banking Supervision distributed an internal memorandum, document BSR 2025-14, to the 12 regional Federal Reserve banks. The memo outlined new examination procedures for commercial real estate loan portfolios at institutions with assets between $10 billion and $250 billion. The memo wasn't public. It wasn't announced. It was distributed through secure channels to examination teams, with explicit instructions that its contents not be shared with examined institutions until the examination process began. The new procedures required banks to mark commercial real estate loans to current market value rather than historical cost. They required stress testing against a 40% decline in commercial property values. They required immediate recognition of impairments that previous accounting standards allowed to be deferred. Under the old rules, a bank could hold a loan on a half-empty office building at its original value as long as the borrower kept making payments. Under the new rules, that same loan had to be written down to reflect what the building would actually sell for today. The difference between those two numbers, between the fantasy and the reality, is what killed 14 banks in 5 days. At 4:15 a.m. Eastern, on January 14th, FDIC examiners arrived simultaneously at First Regional Bancorp headquarters in Phoenix, Mountain West Financial in Denver, and Great Lakes Commerce Bank in Detroit. No advance notice, no negotiation period. The institutions were informed that based on examination findings, they were being placed into receivership, effective immediately. By 9 a.m., the FDIC had announced the seizures. By noon, JPMorgan Chase had submitted winning bids for all 3 institutions' deposit franchises and selected assets. The pattern repeated for 11 more banks over the next 5 days. Each seizure followed the same script: surprise examination, immediate receivership, rapid acquisition by one of the 4 largest banks, JPMorgan, Bank of America, Wells Fargo, or Citigroup. 14 banks failed. 4 banks acquired them all. The regional banking sector lost $347 billion in assets. The money center banks gained $280 billion in deposits. That's not crisis management. That's consolidation by design. The mechanism hiding the losses was simple, and the simplicity was deliberate. Commercial real estate loans don't trade on exchanges. There's no ticker showing you the current price. The value of a loan is whatever the bank says it is, subject to accounting rules that have, until now, provided enormous flexibility. A bank holds a $100 million loan on an office building in downtown San Francisco. The building is 62% occupied. Comparable properties are selling at 45 cents on the dollar. What's the loan worth? Under pre-2026 accounting, the answer was $100 million, as long as the borrower is current on payments. The logic was that the bank intended to hold the loan to maturity, so short-term market fluctuations didn't matter. Under the new examination standards, the answer is $45 million. Maybe less, because distressed sales often go below comparable transactions. The $55 million difference has to be recognized immediately as a loss. That loss reduces capital, and banks are required to maintain minimum capital ratios. Regional banks were sitting on an estimated $650 billion in commercial real estate loans that would require write-downs under the new standards. The 14 that failed were simply the first to be examined. They won't be the last. This is where the lie becomes unsustainable. The commercial real estate crisis didn't begin in January 2026. It began in March 2020, when office workers went home and never fully returned. Office occupancy in major American cities remains at 52% of pre-pandemic levels. That's not a temporary adjustment, it's a structural shift. Companies discovered that remote work functioned. They reduced their footprints. Leases expired and weren't renewed. New leases, when signed, were for smaller spaces at lower rates. The buildings didn't disappear. The loans on those buildings didn't disappear. But the income supporting those loans collapsed, and the banking system spent 4 years pretending it hadn't. The total commercial real estate loan exposure in the American banking system is $2.7 trillion. Regional banks, those between $10 billion and $250 billion in assets, hold approximately $1.4 trillion of that exposure. The largest banks, with their stricter internal risk standards and greater diversification, hold the rest. At a 35% average impairment rate, consistent with current transaction prices for distressed office properties, the regional banking sector faces $490 billion in unrealized losses. Total equity capital in the regional banking sector is $380 billion. The math is straightforward. The losses exceed the capital. Not at every bank, but at enough banks to create a systemic event. The July memo wasn't a policy change. It was a trigger mechanism. Regulators knew the losses existed. They knew which banks had the greatest exposure. They had 6 months to prepare the examination teams, coordinate with the FDIC, and, this is the part no one will admit, ensure that acquirers were ready. When institutions coordinate at this level, they're not managing risk, they're engineering outcomes. The evidence of pre-coordination is overwhelming. JPMorgan's acquisition bids were submitted within hours of each seizure announcement. The bids included specific provisions for loss sharing with the FDIC that had clearly been negotiated in advance. Jamie Dimon's statement to investors, "We were prepared for this opportunity," was either a remarkable coincidence or an admission. At 6:30 p.m. Eastern on July 24th, one day after the examination memo was distributed, JPMorgan's chief risk officer, Patricia Moreno, convened an unscheduled meeting with the bank's commercial real estate team. The meeting's subject, according to internal calendars obtained through regulatory filings, CRE portfolio repositioning, acquisition scenarios. 6 months before the first failure, JPMorgan was modeling acquisition scenarios. They knew which banks were vulnerable. They knew the examination process would trigger failures. They knew they would be positioned to acquire. The FDIC's loss-sharing agreements confirm the coordination. Under standard failure resolution, the acquiring bank assumes deposit liabilities and purchases assets at market value. The FDIC covers the difference through the Deposit Insurance Fund. The agreements signed with JPMorgan, Bank of America, Wells Fargo, and Citi for the 14 failed banks include a provision that has never appeared in previous failure resolutions: pre-negotiated loss thresholds. The acquiring banks agreed in advance to accept assets at specific valuations, with the FDIC guaranteeing losses beyond those thresholds. You don't pre-negotiate loss thresholds unless you know the failures are coming. You don't know the failures are coming unless someone told you the examination results before they were announced. Less than 72 hours remain before the next wave of examinations begins. The Federal Reserve has scheduled reviews of 23 additional regional banks for the last 2 weeks of January. The examination criteria are identical to those that triggered the first 14 failures. Market pricing suggests investors already know the outcomes. Regional bank stocks fell an average of 34% between January 14th and January 19th, not just at the failed institutions, but across the entire sector. Credit default swaps on regional bank debt have tripled. Deposit outflows, while not yet at crisis levels, are accelerating. The last time regional bank stocks fell this rapidly was March 2023. 3 banks failed then. 14 have failed now. The trajectory suggests the final number will be significantly higher. While small banks fail, large banks feast. The consolidation dynamic transforms crisis into opportunity for those positioned to exploit it. JPMorgan Chase is now the largest bank in American history. Combined assets exceed $4.2 trillion, larger than the GDP of Germany. They hold 16% of all American deposits, up from 11% before the 2023 failures. Their commercial banking operation has grown by $180 billion in the past week alone. This concentration creates systemic risk that dwarfs the failures it supposedly resolves. 4 banks now control 52% of American banking assets. 4 institutions whose failure would be unthinkable, whose power is now unchallengeable, whose influence over monetary policy, lending standards, and financial regulation is now absolute. Too big to fail has become too big to exist alongside competition. The mechanism benefits the largest banks in three distinct ways. First, they acquire deposits at below-market costs. Failed bank deposits transfer at face value. The FDIC guarantees them, but the acquiring bank pays nothing for the customer relationship. A deposit base that cost the failed bank decades to build transfers instantly. Second, they acquire assets at distressed prices. The commercial real estate loans that destroyed the regional banks are the same loans JPMorgan is buying at 40 to 50 cents on the dollar. If property values ever recover, even partially, the acquirer captures the entire upside. Third, they eliminate competition. Every failed regional bank was a competitor for business loans, commercial relationships, and deposit accounts. The four largest banks now face fewer alternatives in every market where failures occurred. Pricing power increases. Margin compression reverses. The crisis doesn't destroy value. It transfers value. From shareholders of failed banks who lose everything, from the deposit insurance fund that covers losses, from taxpayers who ultimately backstop the fund, to the largest financial institutions in the world. The audit wasn't an audit. It was a mechanism for accelerating a consolidation that regulators, the largest banks, and perhaps the Federal Reserve itself had already decided was necessary. The justification will be stability. The argument will be that concentrated banking is safer banking, that four institutions with trillion-dollar balance sheets can absorb shocks that dozens of smaller institutions cannot. The historical record suggests the opposite, but historical records matter less than the interests of those writing the policy. The $38 billion in FDIC losses from the first 14 failures will be recovered through increased assessments on surviving banks. Those assessments fall disproportionately on the regional institutions that are already weakened. The fee structure accelerates the consolidation it claims to address. The trap is elegant and inescapable. Fail, and your assets transfer to the largest banks. Survive, and your capital is depleted by assessments covering others' failures. Either pathway leads to the same destination, a banking system dominated by four institutions too large to regulate, too powerful to challenge, too interconnected to allow failure. What the informed understand is that this consolidation has been the objective, not the side effect, of regulatory policy since 2008. Dodd-Frank compliance costs eliminated thousands of community banks, institutions too small to afford the regulatory burden. Stress testing requirements advantaged institutions with the resources to build sophisticated modeling capabilities. Capital rules were written by consultants who rotated between regulatory positions and money center bank advisory roles. The regional banks that just failed weren't killed by commercial real estate losses. They were killed by an examination process designed to surface those losses at a moment chosen by regulators, with acquirers already waiting, with loss-sharing agreements already negotiated. The timing wasn't accidental. The coordination wasn't coincidental. The outcome wasn't unfortunate. This is what a system looks like when the rules are written by the winners. Your bank statement shows a number. That number represents a claim on an institution that may or may not survive the examination process now underway. If your bank is one of the 23 scheduled for review in the next 2 weeks, your claim is at risk. Not your deposits. Those are insured up to $250,000. But your relationship, your credit lines, your business banking arrangements, your mortgage servicing, all of it subject to transfer to an institution you didn't choose. The physical reality of banking is simpler than the paper complexity suggests. Banks take deposits and make loans. The difference between what they pay depositors and what they charge borrowers is their margin. The system works as long as loans perform. When loans stop performing, capital absorbs the losses. When losses exceed capital, the bank fails. The commercial real estate loans stopped performing years ago. The capital was never sufficient to absorb the losses. The accounting rules simply allowed the pretense to continue until regulators decided the pretense should end. They decided in July. They acted in January. The 14 failures are the beginning, not the end. The question is not whether more banks will fail. The examination schedule guarantees additional failures. The question is not whether the largest banks will acquire them. The pre-negotiated loss-sharing agreements guarantee acquisition. The question is not whether consolidation will accelerate. Consolidation is the design, not the accident. The only question that matters is whether you understand what your bank statement actually represents. A claim on an institution operating within a system designed to transfer assets from the weak to the strong, from the regional to the national, from the many to the four. JPMorgan knew 6 months ago. They positioned 6 months ago. They're acquiring now what they identified then. The audit revealed nothing that wasn't already known. It simply provided the legal mechanism for acting on knowledge that had been carefully restricted to those who could profit from it. $347 billion in assets, 14 banks, 5 days, 4 acquirers. The numbers tell you everything except who decided it would happen this way and why. That answer isn't in any regulatory filing. It's in the pattern of preparation, the timing of examination, the speed of acquisition, the precision of loss-sharing agreements negotiated before the losses were officially recognized. Reality asserts itself eventually, but in banking, the timing of that assertion is a choice, made by those with the information to anticipate it and the positioning to profit from it. Your bank statement still shows the same number it showed last week. The system that guarantees that number has changed fundamentally in the past 5 days. 14 institutions that looked stable on January 13th no longer exist on January 20th. The difference between those two dates isn't financial deterioration. It's the decision to recognize deterioration that already existed, made at a time chosen by those who benefit from the recognition. That's not a banking system. It's a mechanism for wealth transfer, dressed in the language of prudential regulation and systemic stability. The next 72 hours will reveal whether 23 more banks join the 14 already gone. The examination teams are already in place. The acquisition bids are already drafted. The loss-sharing agreements are already negotiated. The only people who don't know the outcome are the depositors whose claims hang in the balance, and the shareholders who are about to lose everything while the largest banks in history grow larger still. 6 months ago, JPMorgan knew. Now you know too. The difference is they had 6 months to prepare. You have 72 hours.